Ordinarily, I'd love to get your take on Fed macro, but just on this buying the dip mentality in tech that you say reigns relentless. How long lasting is it? Does it make you any more cautious on that space?
Well, look, in general, the buy the dip has worked with the Fed's balance sheet expanding month after month to new highs, and the S&P just keeps following that track. Just the dips into the 50 MA being bought. It's basically the 2013 script when we had the same kind of liquidity avalanche. With tech in particular now, what's interesting when you look at new highs, you always want to look at the participation and the internals as they come about. And on the technology sector right now, these latest new highs this week have been the weakest readings internally that we've seen all year. New highs on the NASDAQ were only about 122 yesterday. Back in February was 600, in April was 250, so it's kind of declining. Another measure here is the 50-day moving average participation. They were at 88 in the earlier highs in the year, and yesterday was only 62. So what this points to is an internal weakening in terms of participation. And for those highs to be sustainable, you really want to see a broadening out of that participation.
I did notice today that the FANG Plus index, although up 10 for the year to date, is still the weakest first half in about 5 years. I wonder where you think it leaves some of those names in the more speculative space in mobility and EVs that have had obviously a rough 2021. Does that gap get filled?
That is an interesting one because, we look at markets as general being just a steady bull market here and the indices from SPY to NASDAQ and what have you. But what's fascinating is the absolute carnage that's actually been taking place. Tesla peaked in January, dropped 40%. We saw that with SPACs the same way. And of course, in companies like ARK or Coinbase, as you mentioned. So these stocks have actually seen significant drops, significant damage for anyone buying them late. And what we need to see for these stocks is an improvement in terms of their charts. And they've gone from bear flag to bear flag to bear flag. Tesla made some progress today, getting above the 50 MA. And as long as that's sustainable, then that's positive for the stock for further upside, for example. So if these come along, then yes, but they're also still in bear flag. So we got to be very cautious here on how these technicals evolve.
Sven, tell me, what do you think, revisiting a theme we touched on with Dan Niles earlier in the week, as easy money from the Fed dries up, who in tech gets hurt?
Well, I think the big FANGs would ultimately get hurt if interest rates rise. I mean, we saw a little bit of this last week, right? I mean, the notion that the 10-year drops and then we immediately see a positive rotation back into tech just underscores how important the yield equation is. And to me, the 10-year is really critical to watch. We've been kind of in a lower downtrend on the 10-year, but it's got a bullish pattern. I mean, as long as it stays above 141 on a sustained basis, it has potential to move higher. And then I think tech is going to be at risk here.
Sven, good morning. It's Deirdre. You mentioned the more speculative trades, Tesla, SPACs, and you also said in your note that you're impressed that the larger tech sector hasn't seen any fallout from the drop in these trades. Why do you think that's the case? Are they disconnected?
Well, this is what we saw kind of in 2000. It's very interesting. In 2000, the tech bubble burst in March, right? But the large indices were unaffected for months. I mean, we had a big chopping trading range in the Dow, in the SPY. So the question to me is, are these things getting hit hard on the speculative side a sign maybe that the overall larger asset bubble is at risk and that there's a lag factor? So far, we have not seen that evidence. But, if we see new highs fail on the larger indices, I think watch out, because we just saw a trend break, for example, in the Dow in the last week, and that's trying to repair itself. There's technical damage underneath, despite the new high. So I think in general, I think we need to keep a very close eye on, because these markets are so extended historically, since we haven't had a single correction since last fall. There's always larger reversion risk on a trigger.